Getting approved for a personal loan online has never been faster. In many cases, the entire application can be completed from your phone or computer, and if you're approved, the money could arrive in your bank account in just a few days, or sometimes even sooner. But speed isn't the same as making the right financial decision. A personal loan can help you consolidate debt, cover an emergency, or pay for a major expense. On the other hand, choosing the wrong lender or overlooking the fine print could leave you paying thousands of dollars more than necessary. So before you click that Apply Now button, here are the key steps that can help you borrow smarter, improve your chances of approval, and potentially save money over the life of the loan. Online personal loans have become one of the most convenient ways to borrow money. Instead of visiting a bank branch, most lenders now allow you to complete the entire process online, from checking your eligibility to signing the final loan documents. The application usually requires basic personal information, along with documents that verify your identity, income, and financial situation. However, getting approved isn't just about filling out an application. Lenders want to know whether you can comfortably repay the loan. And the stronger your financial profile, the better your chances of qualifying for competitive interest rates and favorable loan terms. In this video, we'll walk through the complete process of getting a personal loan online, explain what lenders look for, show you how to compare loan offers, and discuss when taking out a personal loan may or may not be the right financial decision. Let's start with the first and one of the most important steps. Get your finances ready before you apply. Before comparing lenders or submitting an application, take a close look at your own financial situation. One of the first things lenders review is your credit history. That's why it's a good idea to check your credit report beforehand and make sure everything is accurate. If you notice mistakes or incorrect information, disputing those errors before applying could improve your chances of approval. Your income also plays a major role. Lenders want to see that you have a reliable source of income and that your monthly obligations leave enough room to comfortably repay a new loan. Another important factor is your debt-to-income ratio, often called your DTI ratio. This compares your monthly debt payments to your income and helps lenders determine whether you're already carrying too much debt. In general, borrowers with stronger credit, stable income, and lower debt levels are more likely to qualify and often receive lower interest rates and better repayment terms. Preparing your finances before applying can make the rest of the process much smoother. Compare multiple lenders instead of accepting the first offer. One of the biggest mistakes borrowers make is accepting the first loan offer they see. Different lenders can offer very different interest rates, fees, loan amounts, and repayment options even for the same borrower. That's why it pays to compare multiple lenders before making a decision. Start by reviewing each lender's eligibility requirements, available loan amounts, repayment terms, and customer feedback. Your current bank or credit union may also offer personal loans, so it's worth including them in your comparison. Many lenders also allow you to pre-qualify. Pre-qualification usually involves providing some basic information and authorizing a soft credit inquiry. Unlike a hard credit check, a soft inquiry generally doesn't affect your credit score and can give you an estimate of the loan amount, interest rate, and monthly payment you may qualify for. While pre-qualification isn't a guarantee of final approval, it can make it much easier to compare offers before submitting a formal application. Submit your application carefully. After comparing your options, it's time to choose the lender that best fits your needs and complete the full application. At this stage, most lenders perform a hard credit inquiry as part of their final review. You'll typically need to upload documents that confirm your identity, address, income, and overall financial situation. Depending on the lender, these documents may include a government-issued photo ID, proof of address, recent pay stubs, tax documents, bank statements, or other financial records. Providing complete and accurate information is important because missing documents or inconsistencies can delay the approval process. Once everything has been reviewed, the lender will decide whether to approve the loan and provide a formal loan offer outlining the terms. Review every detail before you sign. Receiving an approval is exciting, but don't rush to accept the offer. Take time to carefully review every part of the loan agreement. Look beyond the monthly payment and pay close attention to the annual percentage rate, or APR, which reflects the overall borrowing cost. Also, check for origination fees, late payment fees, and any other charges that could increase the total cost of the loan. If possible, avoid loans that include prepayment penalties, since those fees can reduce the savings you'd normally get by paying off your loan early. Finally, Compare the final offer with the estimate you received during pre-qualification to make sure there haven't been any unexpected changes. Once you're comfortable with the terms, you can sign the loan documents. Depending on the lender, the funds may arrive as soon as the same day, or could take up to about a week. After that, repayment begins according to your agreed schedule, and many lenders offer automatic payments to help reduce the risk of missing a due date. Compare the loan amount, interest rate, and total cost. Now that you've received one or more loan offers, it's time to look beyond the approval itself and compare what each loan will actually cost. Start with the loan amount. Make sure the lender offers enough to cover your needs, but avoid borrowing more than necessary. Taking out a larger loan than you need means paying interest on money you didn't really have to borrow. For example, if you're planning a home renovation that requires $25,000, a lender with a maximum loan amount of only $20,000 may not be the right fit. On the other hand, if you only need $2,000, but a lender won't issue loans smaller than $2,500, you could end up carrying extra debt you didn't intend to take on. Next, compare the interest rate and the annual percentage rate, or APR. Even a small difference in the APR can significantly change the total amount you'll repay over time. Here's an example. A 7-year personal loan of $30,000 with a 10% APR would cost approximately $11,835 in interest over the life of the loan. Increase that APR to 11% and the total interest rises to about $13,149. That's more than $1,300 in additional interest from just a 1 percentage point increase. Also, review any extra costs, such as origination fees, late payment fees, or other charges that could increase the overall expense of borrowing. If possible, look for loans without prepayment penalties. Those penalties can offset the financial benefit of paying your loan off ahead of schedule. A loan calculator can also be a useful tool. By entering the loan amount, repayment term, and interest rate, you can estimate the total borrowing cost and compare offers more effectively. Understand how the loan term affects your payments. The repayment period, often called the loan term, is another factor that deserves careful attention. Many borrowers naturally focus on the monthly payment because it's the number they'll see every month. But the loan term affects much more than that. A longer repayment period usually lowers your monthly payment, making the loan feel more affordable in the short term. However, because interest continues to accumulate over a longer period, you'll typically pay more in total interest by the time the loan is fully repaid. A shorter loan term works the opposite way. Your monthly payments will generally be higher, but you'll spend less on interest overall and become debt-free sooner. There's no single repayment term that's right for everyone. The best choice is the shortest loan term that comfortably fits your monthly budget. That approach can help reduce the overall cost of borrowing while keeping your payments manageable. Choose a lender you can trust. Getting a competitive interest rate is important, but it's only one part of the borrowing experience. The lender itself matters just as much. Before accepting a loan, spend a few minutes researching the company's reputation. Look at customer reviews and independent ratings to see how other borrowers describe their experience. Consistent complaints about hidden fees, poor customer service, or unexpected delays may be warning signs. Since you're applying online, the overall user experience is also worth considering. A well-designed website or mobile app can make everything easier, from submitting documents to tracking payments after the loan is funded. If you have questions, don't hesitate to contact customer service before applying. Pay attention to how quickly they respond, whether they clearly answer your questions, and how transparent they are about loan terms and funding timelines. Good customer support can make a significant difference if you ever need assistance during the life of your loan. Ask questions, negotiate, and prepare for approval. Many borrowers assume that every loan offer is final, but that's not always the case. Depending on the lender and your financial profile, there may be room to negotiate certain terms. Borrowers with strong credit, stable income, and competitive offers from other lenders may have more flexibility when discussing interest rates or certain fees. While not every lender negotiates, it never hurts to ask politely before accepting the offer. Once you've chosen the loan that best fits your needs, make sure you've submitted all required documentation. Most online lenders ask for proof of identity, proof of address, contact information, income verification such as pay stubs, W-2 forms, tax returns, or 1,099 seconds, as well as bank statements or information about your existing debts. Lenders review these documents to confirm that your income is stable and that your debt-to-income ratio falls within their lending guidelines. Credit score is another key consideration. Many lenders require a minimum credit score of around 580 or higher, although requirements vary from one lender to another. Keep in mind that qualifying for a loan and qualifying for the best loan are not always the same thing. Borrowers with higher credit scores, lower debt levels, and stronger income generally have a better chance of receiving lower interest rates and more favorable repayment terms. And if your credit isn't perfect, approval may still be possible, but the loan will often come with a higher interest rate to reflect the additional lending risk. By understanding what lenders evaluate before making their decision, you'll be better prepared to present the strongest application possible. Compare the loan amount, interest rate, and total cost. Now that you've received one or more loan offers, it's time to compare what each loan will actually cost. Start with the loan amount. Borrow enough to meet your needs, but avoid taking on more debt than necessary. Next, compare the interest rate and the annual percentage rate, or APR. Even a small difference in APR can significantly increase the total amount you repay over the life of the loan. Also, review any additional costs, such as origination fees, late payment fees, or other charges. If possible, avoid loans with prepayment penalties, since they can reduce the savings from paying off your loan early. Using a loan calculator can also help you estimate the total borrowing cost and compare offers more effectively before making a final decision. Applying for a personal loan online has become faster and more convenient than ever. From checking your eligibility to signing the final paperwork, the entire process can often be completed without visiting a bank branch. But convenience shouldn't replace careful decision-making. Before accepting any loan, compare multiple lenders. Understand the interest rate and total borrowing cost. Review all fees, choose a repayment term that fits your budget, and read every detail of the loan agreement. Most importantly, borrow only when the purpose is worthwhile, and you have a clear plan to repay the debt on time. A personal loan should support your financial goals, not create additional financial stress. Making informed decisions today can help protect both your budget and your credit in the future. If you found this guide helpful, consider sharing it with someone who's thinking about applying for a personal loan. And if you enjoy straightforward explanations of personal finance, investing, banking, and the economy, be sure to check out our other videos. Thanks for watching. We'll continue following the latest developments in personal finance and consumer lending. See you in the next video.